Hello and welcome to this episode of the ETFatlas.com podcast. ETF Atlas is your go-to resource for a comprehensive database of ETFs from the United States, Canada, and Europe. So if you're looking for reliable, unbiased information to guide your investment journey, you're in the right place. I'm delighted to have a very special guest with us today, Karsten Jeske, also known as Big Earn from retirementnow.com. Karsten, thank you so much for joining us. And to start things off, could you please introduce yourself for our listeners if someone doesn't know you, although you're very well known, at least in the FIRE movement, and tell us a little about your background and how you got interested in financial independence and early retirement.
Yeah, thanks for the invitation. Glad to be here. As you mentioned, I'm a blogger in the FIRE community, stands for Financial Independence, Retire Early. And so my background is I grew up in Germany and came to the United States 30 years ago for grad school. I did my PhD in economics, worked in all sorts of different areas in academia, in government, used to work for the Federal Reserve. I also worked in asset management for Bank of New York Mellon. And so that was actually my last job before retirement. So 2018, I retired from that. And so I'm now enjoying retired life. And of course, I'm still staying busy, right? I'm running a blog. I'm going to conferences. I appear on podcasts. I also enjoy retired life. So I have more time to spend with family, travel. We try to spend something like 10 to 12 weeks traveling every year, my wife, my daughter, and I. So we try to max that out. And so my claim to fame apparently is my safe withdrawal rate series. So I researched this issue very much in detail. So for my own benefit, because it gave me the confidence to finally pull the plug in 2018. But I also publish it for the benefit of everybody else. So to enjoy the research and then also enjoy some of the tools. So where you can simulate your own retirement scenarios and factor in all sorts of idiosyncratic parameters that you may have, something like your cash flows, positive cash flows like pensions and social security, or negative cash flows like if you want to hedge for, say, health expenditures later in retirement. So that's one claim to fame. The other claim to fame is that I run an option trading strategy that also helps me in my personal retirement planning. So I'm still staying busy in the personal finance community, even after my retirement 7 years ago.
Thank you. I have a bunch of questions to you, so we will go into certain areas deeper in a minute. But my first question to you after just introduction would be, because you mentioned you're from Germany, how did your experience moving from Germany to the United States shape your thinking, the way how you think about money and investing and financial independence? Is there any maybe difference between Europe and Germany in specific and United States?
Europe in general and Germany in particular, a lot of people rely on the government for their retirement planning, which I think is a terrible idea because, governments are probably, if you think that people are bad with their money, I think the only folks even worse than consumers might actually be the government trying to manage your retirement finances. So I came from Germany to the United States very young, so I never really got too used to that German philosophy. So I basically showed up in the US as this blue-eyed, naive, and idealistic young grad student. And so I picked up some of the American ways of life in terms of, thinking very independently, not relying on the government, because it was actually one of the fears, one of the negatives moving to the US, right? I'm giving up this fantastic, luxurious and generous German retirement system, which it's no longer. But back then I thought it might have been. And coming to the US, where everybody has to fight for themselves. And that definitely struck in your mind that while you have to be financially conservative in the sense that, I mean, don't spend everything you make, put money on the side and prepare for your old age, because the government might not pay you anything in the US. So it actually worked out really well for me, because it means that I put aside a lot of savings and retirement savings. Because of the long horizon, obviously, I said, well, I can put this as aggressive as possible, right? So I just put this 100% equity index funds and let that run. So that worked out really well for me. So I got my first job out of grad school in the year 2000, and in 2018 I was actually ready to retire and had a pretty nice nest egg and enough cash flow and passive income from that portfolio that I could just quit my job.
So, but what was the main reason, what inspired you to leave your professional career? Because you worked, for example, for the Federal Reserve, and how you became an advocate and actually now even a leader in the FIRE movement?
Right. So, I mean, at some point you realize there's more to life than money, right? Money and fame. And obviously I had a fantastic job, both at the Fed and then at BNY Mellon. So I was working in the research department as a very senior researcher. And so everybody looked up to us, right? So we were the brain trust, and people, so we were the superstars, and we were very well paid, very highly regarded. And I definitely could have done that for many more years, maybe not until I'm 67, but I definitely could have done that a few more years. But you also realize that time is running out, right? So you can always use more money, but you will always compare yourself to somebody who has even more money. Right. But there are other things that there's only 24 hours a day that you can spend with your family. So there isn't one billionaire or 100x billionaire who can spend 36 hours a day with their family, right? We all just have 24 hours. And so in my view, the ultimate luxury is not a bigger car or a bigger house or fancier clothes or handbags or shoes. It's the ultimate luxury is to have more time to spend with your loved ones, to travel more. And also to travel in a more relaxed fashion. So, for example, if you work in a corporate job in the US, even though I actually had it really good, right? I think I had 23 vacation days per year. So it's a 23 weekdays of vacation days, so 4.5 weeks. So we could travel sometimes internationally, but even if you travel and you quote unquote waste or blow half of your annual vacation budget on an international trip, it's only 2 weeks. Right? You spend 2 weeks in Europe over the summer. So by the time you got used to the new time zone and you get over the jet lag, you have to fly back again. And then you have the jet lag again back in San Francisco. So even though I had it pretty well in my job, I still had this longing, can I travel more generously? So right after leaving my job in 2018, we did a 7-month trip around the world and then settled down in Washington State and then did another 4 months of travel in 2019. So luckily all before the pandemic hit. So that was a very good timing. So again, I mean, I could have done the job for a number of more years. I still know people who work in the company. They're all very happy. They've all now been promoted beyond what I would have ever thought. We could have moved up. So some of my peers that are now very, very high up in the corporate ladder there. So if I had stayed there, I think it would have done very lucrative and very nice. But there's also the opportunity cost, right? You lose time with your loved ones. So, for example, the way we teach opportunity cost, right, to undergrad econ students, right, we always say, well, if you have too much fun, your opportunity cost is that you can't make money. Right. So going out to the movies is not just the cost of the movie ticket, it's also the opportunity cost of not going to work. But then if you have a lot of money, the opportunity cost works the other way around, right? Making more money, you have the opportunity cost that you don't have enough fun in life. So, that opportunity cost equation changed and flipped for me. And so making that discovery was quite mind blowing. And I said, okay, so I have to pull the plug. And already in 2016, I probably had enough money. I didn't realize it at the time. And you do another year, and then 2017 comes around, and you say, oh, let's do another year. But then in 2018, I finally thought, I mean, it's not just enough. It's more than enough to never work again. So it worked out pretty well so far.
You mentioned that you had a very well-paid job, and many people believe that early retirement is only possible for high earners or maybe very wealthy people. How do you respond to that, and what are some maybe common misconceptions you've seen about FIRE?
Right. So I don't believe that there are any strict, either necessary or sufficient conditions for FIRE. Right. I mean, you can check all the boxes where you say you have a high paying job, very educated, no children, dual earners, in a low cost of living area. And even people like that might still mess up and overspend and never make it to FIRE. And then you have, on the other hand, you have very middle class people in very mundane jobs that are not that highly paid, but they have a frugal lifestyle, and they manage to retire early. So I don't think there are really any strict rules on who can, who cannot retire. So, for example, after our daughter was born, my wife was a stay-at-home mom, and so we had only single income family. I lived in a high cost of living area, San Francisco, at that time. So there were a few things that worked against us, and then, of course, a few things that worked in my favor. And we still made it to early retirement. So I agree. I had it easier because I had a pretty fantastic career and a very high income. But I mean, again, I wasn't overly frugal, right? I wrote a blog post about that, which I called stealth frugality, right? So I was in some way, I didn't waste money on anything, but I wasn't overly frugal either. So I always, my rule was that if you're so frugal that people start talking behind your back, what's wrong with this guy? He's making so much money. And so, for example, when we were at the office, right, we would go out for lunch. I mean, not to fancy restaurants, but to our lunch places, and you get a sandwich or a soup or something there, an entree, something like rice and Indian curry. I think the going rate at that time was something like $8 to $10 for a lunch. I could have brought my lunch from home. But people would have looked at you funny. Well, are we not paying you enough money? So why do you have to bring your lunch from home? Why don't you hang out with us and enjoy some of the social benefits of interacting with your colleagues over lunch and going over the most recent gossip? So it costs me a little bit more to do that. And in the end, it didn't make a huge difference, right? So I didn't have to be super frugal to retire early. I still splurged on certain things, and didn't hinder me too much. But then again, when I was retiring, I was age 44. Which sometimes in the FIRE community, right, you're an old guy at 44, right? I mean, now there's 44. Some people, they claim they retired at 22, at half my age. And of course, they're not really retired, right? Then they become something like internet influencers, and it might actually be a more stressful job than the previous job you had. But you get the message. So I retired at actually kind of a middle-aged group. I mean, there's some early retirees. They still call themselves early retired. If you retire in your 50s, that's by nationwide comparison, that's still extremely early. But I mean, within the FIRE community, there are obviously some people that did it a lot faster than I did. And I did it without being overly frugal. And so it worked out that way for me too.
Yeah, I think it's very important to find a sweet spot, because any extremes probably are not the best solutions as a general rule of thumb. But for someone just discovering FIRE, what do you see as the most important first steps, or maybe some mindset shifts to start down that road?
Right. So the mindset shift is people will find excuses to not invest. Right. And so when you talk to people right now, so we're recording this in early August, stock market seems very expensive. And so the average person will then push back and say, well, I'm not going to invest in the stock market right now. It's way too expensive, right? Of course, it was also very expensive 3 years ago, and it has rallied beyond imagination since then. So if you delay your retirement savings like that, so you'll never start. So that's one reason not to start. And then, of course, you talk to the same people, and then the market is down almost 20%, right, as it was in April. And then they say, well, so now the market is cheaper. Are you investing now? And they say, no, well, now I can't invest because it's way too risky because the market is down, and now I'm afraid I'm going to lose everything. And so the people find excuses not to invest. And so especially, so my research shows that, I mean, obviously you should be worried about equity market valuations. And for example, as a retiree, if you retire today, so obviously it's a concern from a sequence of return point of view. And we can chat about this more in detail later. But when you start saving, in fact, the initial equity valuations are not really that important, right? I mean, for my personal experience, I started investing in the year 2000, or at least I started investing aggressively after I got my first job in the year 2000. Boom, was the peak of the dot-com crisis. Of course, my first contributions to my retirement savings, they were terrible, right? They went down by 50%, and eventually it recovered. But investing regularly through the trough, it's also called dollar cost averaging. So that obviously helped me. Or I got a big promotion and a big pay increase by moving into the asset management sector from the Federal Reserve to Bank of New York Mellon. And that was right around the 2007, 2008 market peak. And again, so the initial contributions into my retirement savings were not that lucrative. But if you regularly invest and you automate your savings, you can achieve this goal. I mean, obviously, it's going to take you a few years, but maybe the first few years you don't even want to look at the account statements because it's a very long process, like watching paint dry. So doing it regularly, automating your savings, not stressing out, not overthinking the market timing, because you're not going to get the market timing right? So I used to work at BNY Mellon, so we did market timing, and even for us, it was extremely difficult. So as a retail investor, you're not going to get the market timing right. So just don't overthink, don't stress out, automate your savings.
The 25 times annual expenses rule comes up often in the FIRE discussions. Can you explain where this rule comes from and how it works and who it is or maybe isn't appropriate for?
Right. So, I mean, it's known under multiple names. So it's most known as the 4% rule. Right? So 25x savings means that you withdraw 4% of your corpus in the first year, and then you can increase your withdrawals in line with CPI. So that was invented in the 1990s, and there were two separate sets of researchers. One was the Trinity study, and one was Bill Bengen's study. And they showed that if you have a halfway diversified portfolio, somewhere between 50-50, 50% stocks, 50% fixed income, to 75-25, 75% stocks, 25% bonds. You have a 30-year horizon. If you do this 4% initial withdrawal and keep withdrawing that, most of the time you would not run out of money. Only in the most extreme crazy, exceptional cases like 1929 or 1968 retirement cohorts, historically, would you have run out of money with that strategy? So this is how the 4% rule came about. So that it gives you a pretty good rule of thumb. If you retire and your annual budget is about $100,000, well, you need about $2.5 million. You put that into a diversified portfolio, and then you run with that, and you cross your fingers that you're not going to run out of money. But even in the worst possible case, you probably just barely make it, or you might run out of money after 29 years, which in some cases would still be a success if you have some other income in retirement, like Social Security or pensions. And so this is where the 4% rule came from. And I think it's a pretty decent rule of thumb. Obviously, in practice, right, you should customize this rule, right? I mean, because the 4% rule is I always say that it's like everybody is wearing the same shoe size, right? So everybody wears size 10 shoes, and it's perfect on average. It's going to be too tight or too loose for some people. And it's actually recommending the 4% rule for retirement is actually crazier than the size 10 shoes, because I mean, at least my shoe size hasn't changed over the last 40 years or so. But I mean, even individually, your safe withdrawal rate might change, because you might be at the bottom of a bear market, or you might be at the peak of a bull market, right? So for you personally, you probably have to have a different safe withdrawal rate depending on when you retire. And then obviously for each person, you have idiosyncratic factors that would change your sustainable withdrawal rate. I mean, you could have a 30-year retirement horizon, or you could have a 60-year retirement horizon. Right? That should have an impact on your safe withdrawal rate. You could be happy with depleting your assets, or you might want to leave an inheritance to your loved ones. Right? You might have supplemental cash flows later in retirement, pensions, Social Security. So you could later in retirement then reduce your withdrawals. So that means you can maybe bump up your initial withdrawals, knowing that you will take them down again, maybe 10, 15 years into your retirement. So all sorts of idiosyncratic factors would also then create huge shifts in what is really a sustainable withdrawal rate. So it could be as low as 3%. It could be as high as 5 or 6%. And what people sometimes don't realize is, well, they say, oh, well, from 3% to 4%, that's only a 1% difference. But it's a 1%, it's a 1 percentage point difference, right? But going from 3%, so that's $30,000 a year for $1 million portfolio, to $40,000, that's a 33% increase in your budget. So these are big changes in your retirement finances that you probably want to do some. We say you want to do the math with a very sharp pencil and see. I mean, can I maybe even increase my withdrawal rate by factoring in some of these idiosyncratic factors? And this is really my niche in the personal finance communities, that I propose that you should very much custom tailor your safe withdrawal rate analysis. So my 4% rule might be somebody else's 5% rule, and then yet somebody else's 3% rule.
Yeah, actually, your safe withdrawal rate series on the blog is, I would say, legendary, and goes very deep into the data, which I really like, because I'm also a data-oriented person. And I wanted to ask you, what first motivated you, in fact, to research withdrawal rates so thoroughly? Because I have never met anyone going into details so deeply as you did.
Right. Obviously, it evolved over time, right? So initially, I thought, I'm going to write 5 blog posts, maybe maximum 10. And of course, it's we call it the rabbit hole, right? I mean, you start digging, and then you dig deeper, because then you find different tunnels and different angles that you never knew when existed before you started digging. So again, I mean, this was not my plan when I started the series in 2016, but it just has evolved. But so the reason why I started researching this topic is that I did not think that there was really enough useful information out there. And I don't want to criticize too much the academics, right? Because obviously academics have to do these safe withdrawal rate analysis as generic as possible, right? I mean, they say, well, it's a 30-year horizon, it's a flat spending profile, at least flat in real terms, which means a CPI adjusted, in addition to the initial withdrawal and consumption. And of course, when you write an academic paper, or even a paper for a practitioner journal, you can't really do too much idiosyncratic bells and whistles, right? I mean, you can say, hey, I'm going to do a safe withdrawal rate analysis for somebody who has a 37-year horizon, and then the spending profile is U-shaped or J-shaped. And then there's going to be a pension coming in after 13 years, and then there's a home sale after 24 years. So you can't make it that specific, because then people are going to blame, well, all of the results are really coming from all of these idiosyncratic assumptions and not from the generic safe withdrawal rate analysis. So I don't want to criticize the Bengans and the Trinity studies of the world. And then also the FIRE community, right? When I was initially interested in early retirement, and I started researching this in 2016, I noticed that the existing FIRE influencers were very nonchalant about the risks of retirement, and they didn't really look very deep under the hood. And so my question was, well, I mean, there are two explanations, right? One is there's nothing to look there. And it is actually not very risky at all. Or maybe they're very nonchalant because, a lot of FIRE influencers, right? They have their blog, they have enough income from the blog, so they personally don't have to worry about sequence of return risk. But I have to worry about sequence of return risk, right? Because I mean, even today, I don't really make a lot of money from my blog. And back then I was making zero money from my blog. So I definitely had much bigger concern. And then, of course, I mean, I was actually afraid, well, what if I have a 60-year retirement horizon or a 50-year retirement horizon, and there is no safe withdrawal rate over such a long horizon? Obviously, I was happy to calculate and realize, hey, I mean, if you take your withdrawal rate down a little bit from 4% to maybe 3.5%, right? Even the worst possible historical cohorts like 1929 or 1968, they would have been safe in retirement. And so that was the good news. Of course, the bad news was that, well, we cannot really so willy-nilly extrapolate the 4% rule for over 30 years to 40 years and 50 years and 60 years. So the truth was basically somewhere in between. There was some good news, there was some bad news, and the truth was in between. So and again, so this evolved over many years, and there was no idea that this is going to take me 60 plus posts on safe withdrawal rates, because you never knew what kind of issues are going to come up.
You mentioned the sequence of returns risk. Could you explain what this is in some simple terms and why it matters so much for someone considering FIRE?
Right. So, and this is really why people are always amazed that the safe withdrawal rate is actually relatively low, right? Because you say that, well, a portfolio with equities on average over the last 100 or even 150 years would have returned something like 7% returns already adjusted for inflation. So why isn't the safe withdrawal rate 7%? And why shouldn't we use a 100% equity portfolio, right? And the reason is that if you start withdrawing and right out of the gates, the stock market goes down. And we're not talking about something, basically what happened in April this year, which was a very swift down move and a very swift recovery, right? We're talking about something like the Great Depression or the 1970s and 80s. So the move from, say, 1968 to 1982, there weren't even very deep drawdowns, but the drawdowns, they were deep enough and long enough that if you had retired in 1968, your portfolio would have been down so much, then net of withdrawals, you would have depleted your portfolio so badly that even if you then had a very nice run from something like 1982 until 2000 to 2001, really, even with that recovery, the stock market itself would have recovered, obviously, but your portfolio was so badly depleted that you would have run out of money eventually. And this is really what matters not so much for your retirement success is the average return. over your retirement. It's how the returns are distributed and what is the sequence of returns. Do you have bad returns first and then really good returns afterwards? So that would be really poisonous for your retirement. Whereas if it's the other way around, if you have spectacular returns for the first 15 years and then returns fizzle over the next 15 years, that's actually really good in retirement. So it's actually the sequence of return matters more than the average return.
And it's quite funny because the beginners are very often, frustrated when they start with some, drawdowns. And I remember Paul Merriman once said when I was interviewing him that when it happens at the very, when we start investing and we have a huge drawdown, that's a good reason to buy a good champagne. And expect that the good years will come when we will just go, when we will start our retirement. And just to put maybe in some perspective for our listeners, like you mentioned, the Great Depression, the US stocks dropped by over 80%. So we can imagine what happens to our psychology. I mean, even when we are in such a big drawdown. And we mentioned already also the valuations, the stock market valuations, and we said that they are quite high today, and which may be a good reason to say, oh, okay, maybe I will wait. But as shown by metrics like, for example, the CAPE ratio, indeed, we can say that there is something in it. Should people planning for retirement or maybe early retirement be worried about such a high CAPE ratio valuations, and how do they affect the safe withdrawal rate?
Yes, short answer is yes. I mean, you should be concerned about it. I wouldn't call it worried, but so for example, there is no CAPE ratio that would say that, well, you cannot retire at all, right? So even at the peak of the .com bubble, if you had retired at that time, if you have a reasonably diversified portfolio, you have a little bit of bonds in there, anywhere between, say, 40 to 20% bonds and 60 to 80% stocks, you would have done okay, even at the peak of the .com crisis. And we are not quite as crazy overvalued as back then. So crossing my fingers that I think even today, it is possible to still retire and retire comfortably. I probably would take down my withdrawals a little bit, right? And as I mentioned earlier, if we put investors into three different buckets, right? So in the middle, we have a buy and hold investor, right? So somebody who has a big chunk of money, invests this money over the next 30 years, and then wants to see what happens, what comes out after 30 years. Actually, very few people are like that, right? I mean, either you're putting money in or you're taking money out. There are very few phases in your life where you have, say, a 30-year horizon where you don't do anything to your portfolio over the next 30 years. No inflows and no outflows. But even so, let's take this buy and hold investor. I mean, there's definitely a huge correlation between the next 10 years of real returns and the CAPE ratio that was prevailing at the beginning of a 10-year window. And it's statistically so significant. I mean, it's significant beyond belief. And there's so many. We can measure this as a t-statistic of basically draw a scatter plot, and then you look at what's the slope parameter. Is this a positive or negative slope? You can definitely tell that there's a relationship between equity valuations and returns over the next 10 years. And then we go in the one direction. How about a retiree, right? So that correlation between your retirement success and the initial CAPE ratios is even stronger, is even, in a statistical sense, even more significant. But the good news is that if you are just starting out and you're putting money in, so you're on the other side of the buy and hold investor, so you have zero initial assets, but you're putting money in, that's actually a relatively loose correlation between your initial equity valuations and your outcome after 10 years. So there's different people should worry at different levels about the equity valuations. It goes back to exactly the point that Merriman made, right? With the valuations that we have today, there is a possibility that we have a pretty big drawdown, that we have another 50% drop over the next, say, 18 months. And then out of that, I mean, every stock market bubble that burst has always recovered. And so if you have a long enough horizon, that's actually it's actually not a bad thing that you have a little bit of a drawdown and then a recovery. Of course, it would be bad if you have a drawdown and then the recovery is also very, very lackluster, right? I mean, normally what happens in some of these bear markets is that you drop very precipitously, but then you also come out of it, and it's almost like a slingshot move out of that bear market, where from the bottom, you don't just recover at some average, say, 7% annualized real equity returns. You're going to have, at least for a few years, you're going to have double-digit equity returns again. And so if that's the kind of drawdown and recovery, then the average saver would actually benefit from that. Now, retirees don't, and that's obviously something to worry about. But again, so for new savers, don't really stress out. Don't overthink the expensive equity market, and I think just put your money in the market and automate it, and don't try to time the market.
Set and forget, as they say. You often suggest the, I would say, relatively high equity allocation in the portfolio, like 60, 80%, if I'm correct. Even in your personal portfolio, you have like 75% of equities. How did you land on that range of that equity level? And does the ideal allocation maybe should change when someone has retired?
Right. So, I mean, first of all, when I was accumulating, I was 100% equities. And then I shifted into something a little bit less risky, which actually turns out, I think in hindsight, I would have done better if I had stayed 100% equities. But then again, hindsight is 2020. Sure. But I mean, yes, obviously, I have done the research, and I think that if you're not too risk averse and you can stomach some of the volatility, I think during the accumulation phase, you shouldn't be too worried about the market volatility. And it goes back to dollar cost averaging. So in some way, while you're contributing, and you're contributing regularly, you shouldn't fear volatility. You should almost embrace it. And because it means, well, the dollar cost averaging is the opposite of sequence of returns. So actually, sequence of return risk is everything, right? It's for the retiree, and the dollar cost averaging is part of sequence of return risk too. So dollar cost averaging will help you, and you should in some sense embrace volatility. But obviously, once you're in retirement, now you need a little bit of a diversifying asset. And it goes back to some of the simulations that I did. So historical simulations indicate that 100% equity portfolio around the absolute worst case scenarios would have done so much worse than, say, a 75-25 or 60-40. So really, the 75-25 or 60-40 is, think of that as an insurance, right? Insurance, I buy car insurance and homeowners insurance and health insurance. And I know that on average, what I put in and pay for it is less than what I get out of it, but I still like it because this insurance helps me during some of the worst possible scenarios. And so in that sense, I have shifted to now something like 75% equities, 25% fixed income, just to have a little bit smoother ride and to sleep better. Even though, I mean, right now, I did the math. I think my spending is actually now low enough as a percentage of my portfolio. I could potentially just do 100% equities from now on. But I just think I sleep better at night when I have a little bit of a diversification benefit from those 25% bonds in the portfolio.
But what's your take on the glide path, which says that maybe we should just decrease the level of equities as our age is growing?
So I've done a lot of research in glide path, and I agree that so there is a glide path where you start with, in fact. So the average target date fund actually starts with only quote unquote 90% stocks and 10% bonds, but this is not a mathematical optimal result. It's actually more of a regulatory constraint. I think the average target date fund, I think, has a 90% equity constraint. And you have to mix in a little bit of diversifying assets. It's basically like a fig leaf to the plan managers. So if somebody loses a lot of money with 100% equity funds, so you can't be sued, right? And at least you have a little bit of an excuse. So during your working life, I think early on, you should have a very high equity allocation. So the average target date fund says 90%. If you are unconstrained, and you do the target date fund kind of from scratch yourself, you should probably even be 100%. You might even, some people propose, well, why don't you do even leveraged ETFs at the beginning? I would probably, I don't know if that's really worth it, especially because you have very little money in the market. Maybe there's no need to leverage that. But I would do 100%. And then the question is, when do you start shifting out of the max equity and start going into bonds, right? And there are different views. In traditional retirement, right, where you have something like a 40-year horizon, people would say, yeah, kind of halfway or a little bit past the halfway point. This is when you shift out, and then you go to something like a 60-40. And then how do you do the shift? Is it linear? Is there some kind of a bend in that curve in there? So there are different views. I personally think that if you have enough risk appetite and you have a little bit of flexibility, you could almost justify staying 100% equities almost all the way until retirement. And then only the last few years you start shifting out. But if I had to do, say, an analysis for so imagine you're running a 401k plan. So 401k plan, these are the company-run retirement savings plans. If you're running a 401k plan for a big publicly traded corporation, I would probably run something like a target date fund, right? Where, say, maybe at age 50, then you start shifting out of that 90-10, and then you go to 60-40. Now, if you are financially sophisticated and you have a little bit of flexibility, especially as a FIRE enthusiast, right? It doesn't matter so much if you retire at age 43 or 44 or 45, right? So if you just get unlucky and your planned retirement date, there's a big recession and bear market, well, you just work another 1 or 2 years. But that may not work so well for the average 401k plan, right? You have to almost hedge this. So if somebody says, this is my retirement date, you have to be super cautious about, well, I want to hedge the possibility that right around that date there is a recession and bear market. But in the FIRE community, we have some more flexibility. So I've made the case that for this small community of early retirees, maybe you could do a more aggressive glide path. Stay at 100%, and maybe only the last few years, that's when you shift out of it. But so again, it may not work for everybody, but for me, it personally worked, and I recommend it to other people like me. Maybe not the overall US retirement planning community, though.
You've mentioned that if someone has a high risk appetite, such person could think about even putting 100% in the portfolio, just the equities. How about some other components like gold, or maybe some alternative assets like trend following managed futures as an additional components, diversifiers, which could maybe help also with the sequence risk? How do you see that?
Right. So again, I personally don't think that you need to hedge volatility so much during accumulation. I absolutely believe that in retirement, you have to be more careful and then look for potentially some other uncorrelated asset classes. Gold has gotten a lot of good press, right? Obviously has run spectacularly well. I think since 1970 till today, it's had some really good returns. Since 2000, I think if you look at the big asset classes, stocks, bonds versus gold, right? And maybe not commodities overall, but gold as that one single commodity, I think had the highest return since 2000. And so that definitely puts gold on everybody's map. And what I like about gold is that it has clearly some correlations with the other asset classes that are hugely beneficial, right? So you, first of all, during the big market blowups, it has a negative correlation with stocks, so that really works. And then gold also seems to work during two types of crisis, right? One is a demand shock and one is a supply shock crisis, as we call it in economics. Demand shock crisis would be something like the global financial crisis, where there's actually a disinflationary or even deflationary crisis, which is amazing, right? Because you would think that gold is a commodity, so it would be correlated with inflation. So if inflation is actually low during a demand shock recession, then commodities overall got clobbered, like oil, natural gas, potentially all of the industrial metals. Usually, if the economy is doing poorly and there's less demand for goods, some of these other commodities, they get hammered. But gold, sometimes even during the demand shock recessions, does really well. It obviously does very well during supply shocks, so inflationary recessions. So in that sense, gold definitely has some fantastic correlations. And I think I am definitely comfortable extrapolating that into the future. So I definitely think that the correlation matrix and the variance covariance matrix of gold versus bonds versus stocks, that we can extrapolate that forward. Now, I personally don't think that gold returns are going to be over the next 25 years again as good as they have been over the last 25 years. So one concern with gold would be, well, could there be some drought periods, right, where gold is just moving sideways, and especially because gold has now become so expensive, say, compared to some other commodities, right? If you look at gold price versus oil price, right? But again, because gold, I mean, you don't put it really in as a return engine, right? Your return engine is your equity portfolio, even in some way your bond portfolio, right? Because now treasuries they have an expected return in real terms of something like 2.5% for the 10-year and 30-year tips rate. That's not bad. But so gold, I mean, it's not so much a return engine; it's more of a diversifier. So I support that idea. I probably wouldn't extrapolate the something like 8 or 9% real returns that gold has delivered over the last few years and decades. Maybe it might be a little bit leaner than that, but I could be wrong. I mean, it's possible that maybe gold has a lot of industrial uses, and then basically a lot of new middle class and upper middle class in countries that value gold a lot, like Middle East and India. Maybe that puts some constraints on gold, on the gold market, and it will shift it up even further. But so I personally don't own gold, but if people think that's their diversifying asset, I'm all in favor of that. Yeah. So some other asset mixes,
like managed futures, for example.
Managed futures. Yeah. So funny thing is, in my career in asset management, so managed futures were the rage in the 2000s, right? So that worked spectacularly well. And managed futures work very well if you have these long cycles where you can milk momentum, right? And then even if there is a momentum direction shift, if the direction shift is also going in the other direction, that move then also lasts long enough. right? But it's not very good if you have very fast reversal. So I don't think that, for example, trend following did very well in April this year, right? Because you kind of got whipsawed because the shifts were too fast. So that's the concern. There are some kind of crises where trend following doesn't do so well. Now, that said, maybe that's when you don't need the trend following, right? So trend following, because the move in April, that's not going to undo your retirement planning, right? What's going to undo your retirement planning is something like the 1970s or 1930s, or even the 2005 to 2008, the big move up, and then the unraveling, because that bear market was obviously long enough that some of these momentum strategies worked really well, right? I mean, you do the momentum on equities. You might do the turning point. You get it a little bit wrong, but then the move down is then long enough that you do well with the trend following there, and you can do it for both bonds and equities and commodities too. There's a lot of commodities that worked really well. Yeah, I mean, I can see how people are interested in these kinds of strategies. I'm a little bit worried that the average retail investor, you have to sell your assets to move it into an ETF that does that for you. So whereas some of this trend following flavors is obviously for big institutional investors a little bit easier, right? Because you can do that on top of your existing portfolios, just with some futures contracts, and you might hire somebody to do that for you while you keep your underlying portfolio. Whereas, I mean, would I want to sell a lot of my equity ETFs to move into a trend following ETF where, well, sometimes you get whipsawed and you have poor returns? Makes it a little bit less attractive. But I generally find the idea of this of trend following and managed futures is quite intriguing. The way it's implemented for retail investors is a bit of a headache to it, right? So,
all right, I understand. How about then, and sorry, I'm asking these questions again and again. I heard people were asking to small cap value, because I know that you expressed, let's put it this way, some skepticism about investing at least heavily in small cap value,
right,
despite maybe some evidence for a premium, which there is. So I just wanted to ask you, what's your take on that?
Right. So I believe markets are efficient. So if you tell me that small cap value, it pays a little bit of a premium to compensate for some macroeconomic risk, I'm totally on board with that, right? And so, for example, I wrote a blog post to check, well, would small cap value help you in my safe withdrawal rate calculations, right? And of course, if you are doing this and you're just feeding in past returns, then it looks like small cap value can increase your safe withdrawal rate, because small cap value did particularly well during certain parts, and it just overlapped perfectly. So it helped you during the 1970s, because there was a big run from the mid 70s until the 80s. Where small cap and value stocks did very well. Is actually small cap stocks then fizzled past 1980, and then value stocks did very well until about 2005, 2006. And then not only did they fizzle, they actually started losing money, right? I mean, at least small cap stocks, they have been flat since 1980. Value stocks have gotten hammered since about 20 years ago. So my point is, well, what happens if we don't get these very high excess returns in the past? If we get only either zero excess returns, or we get only modest excess returns from some of these stock picking flavors, And so I did the simulations for that, and it turns out it doesn't really help you in your safe withdrawal rate analysis. It would only help you if small cap value would again perform as well as, say, in the 1930s and 1970s, where you had these big run-ups in these pharma fringe premiums. And I personally think, well, as now these flavors are known, right? There are very smart stock picking funds that can very quickly recognize what is a small cap and what is a value stock. And I doubt that we can get these kinds of premium returns again. I mean, I wish people good luck. And of all the bad things you can do to your portfolio, it's probably not the worst thing. If anything, my forecast is that it's actually neutral. So I'm not. So people always accuse me that I'm bearish on small cap value. No, I'm neutral on small cap value. So I think the market is efficient. It has the same chance of helping you versus hurting you in your portfolio over the next few years, because that's what an efficient market would predict. And so my analogy for that would be the following, right? Because we're both finance geeks, right? So, for example, the Black-Scholes formula, right, where people won Nobel Prizes for it. Fisher Black didn't, because he died before he could get the Nobel Prize. But Merton and Scholes won a Nobel Prize for that. Well, it turns out that there were some hedge funds that already knew the formula before these guys did the research on that, and they were milking that. Right? They were trading options with the formula and generating alpha. Well, and then, of course, these guys were particularly miffed that then the research came out, and now everybody knows about it, and basically their alpha went away. So the alpha went away after everybody learned about how to properly price options. And nobody in their right mind would say that, oh, yeah, I mean, with the strategies that these guys were running in the 60s and 70s, we can still generate option trading alpha the way we've seen in the past. And I say, no, you can't, because it's now a known. There's now a known formula that everybody knows, and even grad students or even undergrad students know about this now. So you can't extrapolate that old alpha from 50 years ago. It's gone. Deal with it and look for some other alpha sources. And I think the similar flavor is happening here with the small cap and value stocks and small cap value stocks as well.
You mentioned that the markets are efficient, so my bet is that you prefer to buy the whole market, the index fund. But talking about index, do you mean here the S&P 500 or maybe some global stock equities?
I have both. But I have to admit, I am more US centric, and I have been a little bit of procrastinator. I have one 401k where I have pretty sizable positions in the total global equity index. But yeah, I mean, I'm definitely overweight US, which has worked for me very well for most of my career. This calendar year, 2025, is actually, you would have done better with the non-US stocks. And by the way, it's not so much that the stocks did so well, it's because the dollar depreciated. So it's more of an FX story than a stock market story. Yeah, I mean, of course, I travel a little bit, right? So maybe I should have some FX hedge in the form of, say, European stocks, because we like to travel to Europe. Yeah, I have to admit, I haven't done enough in terms of global diversification. Part of it is because I'm even though I grew up in Germany, I'm now a U.S. citizen. I'm very patriotic, so I think, well, U.S. is the best. Yeah, I see that it's on my to-do list, and the question is, well, when do you do the shift, right? How long do you wait now that there's a little bit of momentum building, maybe with the FX rate probably a few months ago would have been the right place. So there's always an excuse not to do it, right? So when US appreciates more than Europe, you don't shift. Once Europe has appreciated vis-a-vis the US, and they say, oh well, now the party is over, so now it's too late to shift. So I'm totally guilty as charged. So I'm not doing as much diversification as I should have and could have.
So on one side, you prefer the plain vanilla indexes when it comes to the equity market. On the other hand, you've written extensively about your options selling. We already mentioned the options, and I'm talking here especially about selling short-term S&P 500 put options. Can you give us some summary how this works and why you include this in your own investing approach? And just before I will just give you the time. I've heard, even, correct me if I'm wrong, in one of the interviews with you that you mentioned that it gives you like 4 or 5 percentage points, which means that basically you don't have to even touch the principal of your portfolio, because actually that covers all your expenses, which sounds like, great idea.
Right. So again, what I'm doing is I'm selling very short-term put options. I also sell even intraday call options. So 0 DTE. So at the market open, I'm selling call options and put options. And then at the market close, I'm also selling overnight put options for the next day. So my philosophy here is that, first of all, it's well documented that there is a vol premium, right? So, which means that implied volatility is higher than realized volatility. So basically what an option is, think of that as an insurance contract. I am the provider of the insurance. So somebody wants to buy a put or a call, think of that as an insurance contract, and I'm the insurance company. And because the implied volatility, so this is the volatility that's used to calculate how big that premium is, because you're calculating what is the probability of tail events. So because that implied volatility is higher than realized, it means that people are on average overpaying for that insurance, right? Just like everybody overpays for insurance, right? If I buy car insurance, I way overpay in terms of the expected value that I ever get out. And then, of course, the reason is the insurance company, where, they have customer service reps and buildings, and their CEO flies around in a private jet. So they have some overhead. And then on top of that, right, they also pay their shareholders. Well, guess what? I mean, I sell insurance, and I don't even have to have a private jet or fancy buildings. So I actually pocket more of that profit, and so I generate some extra income. And there are a few factors that make this strategy extremely attractive. So first of all, it gets rid of one of the problems I just mentioned a few minutes ago, right? I mean, if you want to invest in a managed futures ETF, you have to sell something and invest in an ETF that does that for you. So with the option trading, you don't have to do any of that, right? You keep your portfolio, and then you trade these options on margin on top of that portfolio. So I have a taxable account with Interactive Brokers, and in that account, I have a little bit of equity funds. I think I have something like a 40% share equities, and then 60% is fixed income. So that if I because this is not my only account, right? I have some other accounts which are retirement accounts, and in these retirement accounts, for regulatory reasons, you cannot do that options trading. I can only do that in a regular taxable brokerage account. So that if I mix everything together and I take the average weight, the weighted average of my portfolios, this is how I end up with that 75-25 average. But anyway, so in this portfolio, as I have some equity funds, I have some preferred shares, I have some bonds or bond-like instruments, and then on top of that, I do these trades every day. And of course, the percentage returns that I get every day out of this, they look really small, right? They are in the 0.0 something percent. But you do the math, right? If you make 0.02% every trading day, and you have 250 trading days, boom! I mean, there are your 5% extra returns. And again, this is on top of your existing portfolio. I don't have to replace anything. And then there's also some tax advantages in the US. So some of these trading profits, or even in my case, all of these trading profits, they have a tax advantage treatment. So even though this is about as short term as it gets, it's actually 60% of that is taxed as long term capital gains, and only 40% as short term capital gains. So it's a pretty neat trading strategy. The nice thing is, because I do this every day, right? And then in mathematics, there's something called the central limit theorem, and it basically gives you some, even though each individual day you might potentially have some very negative skewness of returns, right? Sometimes, most of the time, you make money, and then sometimes you have some pretty nasty, gnarly losses. But if you do the distribution of your returns over not just one day, but you do it over a week or month or quarter or year, the returns become more and more normal. And so some of this very unpleasant return distribution then goes away, and it becomes more normal. So I like it from a statistical, from a mathematical point of view, and then also obviously from the retirement planning point of view, right? Because I make enough cash flow from the option trading that covers actually not all of my retirement budget, but a pretty good chunk of my retirement budget. So, and then the rest is, so I have some dividend income, and then the preferred shares, they pay some dividends too. So if I take everything together, then I actually have more. Just the cash flow is more than my retirement budget. So that means I don't have to touch any of my equity holdings or even the bond holdings to live in retirement. So the advantage is that it hedges to some degree the sequence of return risk there. So you don't have to liquidate positions if the market is down. So that's basically, so I say it goes together like milk and cookies,
Yep.
right? So you do the option trading, and in retirement, it's really a good combination. Now, of course, the drawback is I don't get these 4 to 5% extra returns on my entire portfolio, right? Because I have some other holdings. I even have some real estate holdings, so that doesn't apply there. If I apply these trading profits to my overall financial portfolio, it's much less than 4 to 5%. So it's not like I can say, well, I have a 4% safe withdrawal rate, and then I add another 4 to 5%, and now I have an 8 or 9% safe withdrawal rate. Well, that would be false advertising. So maybe I only increase my safe withdrawal rate by, say, 1.6 percentage points, which is still huge, right? I mean, it's from 4% to 5.6. That's a 40% increase in your budget. But it's and it's by the way, at 5.6, I will be just 10 basis points more than Bill Bengen. So I was take that, Bill. But I mean, I don't advertise this too aggressively, because obviously not everybody wants to do this, right? Because it takes some bandwidth out of your retirement day. So I trade in the morning, and as we're recording this, I have my trading screen open here. I monitor my positions. I have some stop losses, and everything is looking good today. So I'm making money today. But once we get off the call, then I'm already going to look at what are going to be my trades for the market close trade. So it's
So how much time it takes you on, because you mentioned that you're doing that on a daily basis. So how much time it takes you on average?
Okay, so if I wanted to keep this really simple, it would take me 10 minutes at the open and 10 minutes at the close. So that would be the absolute minimum commitment every day. And then on top of that, so, well, what do I do if I'm on a transatlantic or trans-Pacific flight, or if I'm on a cruise ship? Even though nowadays, even on cruise ships, you now have very fast internet because of Starlink.
Yeah.
So the solution to that is that I teamed up with a friend of mine who is doing the same strategy, and we can trade each other's account. So if I'm not available, then he trades for me, and vice versa. And so, I mean, for example, I was recently traveling in Asia, and I tell you, the time difference in Asia is terrible, because the market the market open is 9:30 p.m., which is perfect, right? I mean, you end of the day after dinner, you do your market open trades. But then the market close in East Asia time is at 4 a.m. So what do you do between 9:30 and 4 a.m.? Do you sleep in between? Do you sleep only for a few hours and then you set the alarm again and then you get up? And then what do you do when you're done trading at 4 a.m.? Do you just stay up and have breakfast already? Do you go back to bed? So same thing. So basically I told my friend, he's actually Polish too. His name is Karol. And I said, okay, Karl, I did this for a few days, but this is really getting to me. So I don't want to do both trades. So I do the market open trade at 9:30 p.m., but then the trade at 4 a.m. Asian time, you got to do that for me. Even though technically speaking, I could have done it and I was available and I wasn't on a plane. So he did it while I was in Asia, so it worked out pretty well. So we have this little trading commune, and so he can access my account for trading, but I mean, he can't just take my money out of my account. So there's certain limitations on who can do what, it works out really well. And in that case, so that makes this really palatable and also manageable for me.
Do you think it would be possible to automate it, to just write a piece of code?
I'm thinking about that, right? And there are all sorts of tools. Interactive Brokers is really at the forefront of all of this API development. And there is definitely one version of this that I could absolutely 100% automate. The reason why I'm not automating it yet, there's still a little bit of discretion, right? So, and the discretion is, I'm not picking the same strikes, I'm not picking the same deltas, I'm not picking the same premium every single trade. So this is something that I look at every day, and then I pick where are the sweet spots. Now, question is, could I even automate that, right? Determining what is the sweet spot. And I have some ideas how to do that, but that would be probably still years of development. But yes, absolutely. I think the long-term goal is to automate this, and so that's definitely on my to-do list. Yeah.
All right. Okay, so I think that's it for options, and I would like to return to the safe withdrawal topics. And I wanted to ask you about funding the withdrawals. Do you prefer, I mean, because there are some different approaches how to do it, and also in terms of rebalancing, what do you prefer? For example, the simple passive rebalancing, or maybe so-called prime harvesting? What's your reasoning behind your choice here?
Right. So I've played around with some of these parameters. So I personally don't stress out over that. So there's some people who say that through the rebalancing, you can generate even some kind of an alpha, which is ludicrous. You will not generate alpha, because the rebalancing is basically is based on past returns, and I would think that everything that where past returns have been observed, I would think that it's very hard to generate any kind of significant alpha, especially if you do anything kind of some kind of a range bound rebalancing, right? You say you have a 75-25, and then you let your portfolio maybe deviate a little bit by 2 or 3 percentage points, and then if you hit some boundary, then you start rebalancing. So with such a small difference, even if you found some sort of a way basically a way of timing the equity premium, because you're doing it with only such a small percentage of your portfolio, this doesn't really add enough alpha to your portfolio. And then obviously the average retail investor is not gonna have any kind of market timing alpha. But yeah, I mean, so basically I played around in one part of my series where I said, well, what is the impact of the rebalancing frequency, right? Do you do it every month, every 3 months or 6 months or 12 months? And my finding was that as long as you rebalance eventually, right, as say every 12 months, you're going to get very, very similar results. And the only reason why one rebalancing scheme beats another is usually luck, right? So there's one rebalancing scheme where, it did really well because just by luck, the rebalancing exactly hit at the bottom of the 1932 bear market, and you just got that one market timing right. And if you had chosen a different monthly frequency, then you got it exactly wrong, where you rebalanced too far before and too far after the trough. And basically what I was trying to figure out, right, because what I assume in my toolkit is monthly rebalancing. And the monthly rebalancing, even though in practice it seems to be the more complicated method, for simulation purposes, it's the easiest way, right? Because what you assume for monthly rebalancing is that, your portfolio returns are just a weighted average of your underlying assets. And so conceptually, and for doing basically your academic studies and your safe withdrawal rate studies, it's easier to do the monthly rebalancing. It took me quite a lot of programming to get this issue with the infrequent rebalancing. That took me so many lines in MATLAB to get that right, because so you let it drift, but then of course part of it is rebalanced through your withdrawals, right? So if there's a mismatch or some drift, you're going to start taking money out of the assets that are most overvalued or most overrepresented. So you get a little bit of rebalancing through that. But even during the big market moves, obviously, just the withdrawals cannot undo the drift. But so the computing and simulation portion it gets very complicated if you do less frequent rebalancing. But I mean, the nice thing is, what I found was that even though it was mostly noise, the less frequent rebalancing, sometimes it helps, sometimes it hurts. There was a little bit of a gain from less frequent rebalancing. And of course, the reason for that is, why does less frequent rebalancing do just a little bit better? Is because on average, you have some momentum going on, right?
Yeah.
Of course, sometimes you have choppy markets, and then it's good to do monthly rebalancing. Most of the time, though, you have a little bit of momentum going on, and momentum helps you when you have so if you have momentum, what helps you the most is that you let your drift do the job a little bit. But then again, it was so minor that I wouldn't rely on it. But the good news was that if you do my simulation toolkit, it gives you almost something like a worst case scenario, right? So it's so you can say that if you're a little bit sloppy or lazy with your rebalancing, you might even be a basis point or 2% or 2 basis points better with less frequent rebalancing. So the good news is that so my safe withdrawal rate toolkit is actually almost something like a worst case scenario, and so you shouldn't worry about less frequent balancing. Yeah.
Some critics say that your safe withdrawal assumptions are maybe too conservative. How would you respond to this? Because I've seen that a few times already. You heard that for sure as well. So how do you respond to that?
Yeah, so I mean, basically, it depends on how you interpret my results, right? So, and it depends on your preferences. Of course, if you always look at only the fail-safe withdrawal rate, it means that you are withdrawing way too little in 99.9% of the cases, right? And only in the 0.1% or 0.01% or whatever the absolute worst case scenario, what the percentage of that 1 month cohort is, that's when you get it right. And all the other cases, so basically over time, you're probably going to increase your withdrawals. And I have to admit, I did this myself, right? So my initial withdrawals were relatively modest, and we have now shifted up. But I think that I would rather be wrong on this side than on the other side, right? Where you withdraw too much and then you have to cut down expenses. So just the human nature is that we don't like reducing our consumption, but we actually perform really well in terms of so you're a little bit more cautious in the beginning, but then if things don't turn out as badly as you initially planned, then you increase your withdrawals. And I admit that, I would prefer it this way. And it's in many other ways, right? We operate that way too. So I always use this analogy, and I ask people, well, how many flights have you missed? And I'm not saying how many flights have you missed because you miss a connection, right? So I don't know. You fly in the US and you have to fly via Chicago O'Hare, and either summer or winter, right? In the summer it's because of thunderstorms, and in the winter it's because of snowstorms. That happens. But I'm talking about how many flights have people missed where it was in their control, right? So because they left home to go to the airport, and they missed the flight because they just arrived late at the airport. And I mean, I have taken probably, I think probably something around 300 flights, and I'm not talking about 300 flight segments, but I'm talking about 300 times. I went from either home to the airport or from the hotel or friend's house back to the airport. How many of these 300 flights have I missed? And the answer is exactly 0. Right, so I have never missed the flight. And of course, you can accuse me of, well, you're a very inefficient guy because you have wasted so much time sitting at the gate, being there way early, and you have never missed the flight. And well, guess what? I am insisting on having a 0% failure probability on something as trivial as a flight. And of course, if you miss a flight or you get rebooked, you miss one night at the hotel. But even there, I'm not happy with say a 20% failure rate, right? So why are people happy with the 20% failure rate in something as impactful as retirement, where you have only one shot in your life, and you are happy with the 20% failure rate? I'm not happy with a 20% failure rate for something as trivial as a flight. And as a 20% probability of being late to a wedding, 20% probability of being late to a job interview, on a cruise, especially if you miss the flight and you don't make it to your cruise, you miss the entire cruise. So that would actually be a bit of an expensive failure. Then again, a cruise, what is a cruise? It's $5,000-$6,000. It's not as impactful as your retirement. So I kind of wonder. So people are very nonchalant about failure probabilities where they shouldn't be. And so I have not met anybody who tells me, yeah, I took 300 flights in my entire life, and 60 of them I missed because I was too late at the airport. I've never met a person like that, because you would not be able to hold a job. You would not be able to hold to keep up friends and relationships if you're that nonchalant about failure probabilities. But again, I mean, so some people say, if the 20% failure probability is okay in retirement, and I think I want to be more conservative initially, and then raise my withdrawals eventually.
Have your views on safe withdrawal rate, or maybe investing as such, changed since you first retired? It was in 2018, right? So like 7 years ago, especially as some new research and market cycles have come along. So how do you see that?
Generally, my views are the same as before, but yeah, I mean, I definitely admit I'm amazed how well my personal retirement has worked out. And so I looked at the math recently. So I have doubled my portfolio even after withdrawals. And again, as I said before, in hindsight, I could have retired earlier. I could have retired with a higher withdrawal rate. And but I must admit that everything has really worked out as it's not as I predicted, but as basically as I thought the statistical distributions are, right? Because since I retired, right, we've had some market volatility, we've had a bunch of drawdowns. 2018. Right out of the gate, we had that little bit of jitters with the Federal Reserve in late 2018. It was not a bear market, but came very close to a bear market. We had the pandemic in 2020. We had the bear market in 2022, and again, I mean, no two recessions and bear markets are exactly the same, but there are definitely some similarities, right? We had the pandemic, which was a demand shock recession, so bonds worked really well as a diversifier, and we had the 2022 recession, right, where both bonds and stocks got hammered together. So it kind of sort of worked out the way I expected. One thing that I was surprised about was that because I was always ranting and raving against bonds. If you remember some of my really old blog posts from maybe 2017 or 16 even, because bond yields were so poor. And so especially during the accumulation phase, I said, well, I'm not going to have bonds in my portfolio because yields are so low and equities are still doing well. And I'm surprised that bond yields are again back to where I never thought they would be again, right? I mean, we had 5% short-term yields, and even the 10-year yield just a little bit nicked the 5%, I think at least intraday at some point. And so I'm surprised that the bonds, again, so they got completely hammered because the duration effect was terrible for bonds. But I mean, right now, I think the bond market is looking really good. So especially for retirees. So I very wholeheartedly tell people, if you're still 100% equities in retirement, I mean, count your blessings that, I mean, obviously market has done really well. And we are at or very close to all-time highs. But I mean, definitely retirees should be very seriously considering something like a 10-year or even a 30-year treasury bond ETF, something like the IEF or the TLT or whatever your fund family is that you like. And because you mentioned, well, has anything changed? And I mean, I definitely think that bonds are very attractive and is definitely very good diversifier. And I can't tell what equities are going to do, but the CAPE ratio right now is kind of insane. So it's definitely as a hedge for the average retiree. I mean, you need some bonds in your portfolio.
So for someone considering early retirement today, what key advice would you offer to such person?
Yeah. So again, be aware of crazy expensive equity valuations. And again, I can't time exactly what's the turning point, but we can go up another few thousand points in the S&P 500 before things fall apart. I mean, I don't want to time it, but definitely the valuations today look very close to some of the worst case scenarios historically. And I mean, it's definitely probabilities of bad sequence of return risk outcome are elevated. And again, I don't want to talk anybody out of retiring. I mean, just retire with hopefully good diversifying assets. I have something like minimum 20 or 25% bonds, maybe even all the way to 40% bonds. And then maybe take down your safe withdrawal rate a little bit. And by the way, and if it all works out and equities keep rallying, then increase your withdrawals in response to that. But definitely as of today, I would probably be a little bit cautious.
You are very well known for developing the safe withdrawal rate toolbox, which is now also available as a web-based application. And I wanted to ask you if you could just quickly describe the main advantages. What does it offer? And also if there is a difference between the spreadsheet and the web version.
It's actually a pretty basic simulation tool. What I like about it is that, first of all, it does monthly frequency instead of annual frequency. So if you do annual frequency, you might miss the worst case scenario 1929, right? Because the withdrawal rate at the end of 1928 was actually pretty solid, because the big market rally came still from January until September 1928. And then if you look at the other year end, at the end of 1929, the market had already fallen by quite a bit. So that safe withdrawal rate also looked pretty good. It's really only the safe withdrawal rate right before the market turned around that was really bad. And there's a similar mechanics also happened in the 1960s. So annual frequency versus monthly frequency is could make a big difference in if you're looking for some of the fail-safe withdrawal rates. Yeah, and then the other advantage is that you can factor in all of your own personal additional cash flows. You can set the horizon any way you want. You can also play around with what I call a scaling factor, right? So you can mimic something like you withdraw X dollars at the beginning, and then you do not just CPI adjustments, but you can do CPI plus X% or CPI minus X%, or anything in between, where you say CPI plus X% for the first 20 years, because you're still young and you still want to keep up, say, not just with CPI, but even CPI plus per capita GDP growth, right? You want to keep up with the Joneses. But then when you age, that's when you do that traditional thing where you say, well, if I'm 75 or 80 years old, I'll probably scale back a little bit my consumption. So there are all sorts of hacks that you can do with a spreadsheet. And then a bunch of other interesting techniques. I have the in the spreadsheet. You can also look at CAPE-based safe withdrawal rates, where your withdrawal rate is a function of not the CAPE, but 1 over the CAPE, which is the earnings yield. And so that's the spreadsheet. Some people are a little bit intimidated by the spreadsheet, and I said, I'm not going to touch that. So this is why I came up with the web-based tool. And it's actually, I didn't program this; a friend of mine programmed that, but with my input and my back and forth. And there is some overlap between the two tools, and there are all sorts of features that are in the spreadsheet that are not yet in the web-based tool. But there's one nice feature in the web-based tool, is that you can save your parameters, and you don't have to enter the parameters every single time in the web-based tool. So you can upload them. You can download them onto your hard drive as I think it's a CSV or Excel file. And then you can upload them again. And then you can even edit your parameters in the spreadsheet. If again, I'm more of a spreadsheet guy and not a web guy. So, and then upload the altered parameters back to the web base. So it's a pretty neat tool. And then you can play with some other tools. So, for example, the one thing that we have in the web based tool that I don't have in the spreadsheet is that you have these sliding bars, and in the sliding bars you can set ranges of CAPE ratios and then calculate what is the probability of a failure, not just unconditional but also conditional on, well, today's CAPE ratio is above 20 or even 30. Well, how would that have worked out historically? And then it's very responsive, and it's very simple calculations. So you change the sliding bars, and everything responds already automatically in the sheet. I'm very 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 impressed with what my buddy John did there. Yeah. So and it's all free, and I hope people find this useful. So
yeah, I also highly recommend it. It's a great tool, and really congratulations on making such a great tool. And it's free. We are slowly reaching to the end, but I have just some final questions, and I wanted to ask you, what does a typical day look like for you in early retirement, and has your experience matched your expectations before leaving full-time work?
Yeah, so you caught me during a pretty slow day in the summer, and we were just between two trips. And it was a Monday, so I had to get up early and do my trades in the morning. But there's not much else going on. But we do leave on a trip again tomorrow. So we're going to fly to New York and spend some time in Manhattan, and then board a cruise ship on Thursday and do a cruise from New York via Nova Scotia, Newfoundland, Iceland, Greenland. No, Greenland first and then Iceland, and then fly back from Iceland back home. So we travel a lot. So I travel about 10 to 12 weeks total every year. And so part of this, a little bit of that is going to conferences and FIRE events. But most of that is actually traveling with my wife and my daughter. So we pretty much max out all of our summer break, spring break, and winter break, and do a lot of aggressive traveling, including trans-Pacific and transatlantic flights and everything. And but when we are home, I mean, I'm just a regular stay-at-home dad, basically. So we get up in the morning. My daughter gets ready for school. I take my daughter to the school bus stop, and she's still at that age where she finds that probably once she's a little bit older, she will probably say, Dad, you don't have to do that anymore. But so I still enjoy that. And, and you wave to the kid. And now she did this during elementary school. Now she's starting middle school. So probably that will end pretty soon. But I take my daughter to the school bus. I pick her up from the school bus stop. We spend a lot of time with our daughter on extracurricular activities. My wife volunteers a lot at school. I volunteer at school and at church. And so I was the coach of the math team. We have a mathematics team at my daughter's school. And the last 2 years, 4th grade and 5th grade, I was the coach, and I took the kids to won all sorts of local and regional competitions. Even statewide, we did very well. So yeah, we would do a lot of fun stuff, and it's maybe not as much as a job. It's probably not even a part-time job, but it's very fulfilling and rewarding during, say, the school year. And then break time, we travel very aggressively. We hang out a lot with family. A lot of the cruises that we do is not just the three of us. It would be 3 of us plus family and or friends. So we're very busy traveling and having a good time. And so it's actually for us, the constraint on travel is less the monetary constraint, is more of the time constraint. So we could actually spend even more. But we can't, because we have only so many weeks of school vacation, and then that's it.
Sure, of course. And what about your future plans, both on the personal level and also the early retirement now blog, and maybe some new tools? Anything on the way?
Yeah. So I have scaled back my publishing frequency of the blog. So if anything, I'll actually look for ways to not work as much on the blog. I mean, obviously, what's planned. One plan would be a book, right? A book about safe withdrawal rates. I have a few other business ventures that I'm pursuing. I'm working on a fintech tool with a bunch of friends of mine. It has nothing to do with the blog. It's completely separate. It's a portfolio analysis tool that I work with a bunch of other math geeks, it's all PhDs, finance PhD, physics PhD, econ PhD from a former job. And so working on that. So the little ventures here and there, and so it keeps me busy. And then obviously, so some of the volunteering that's also a big part of my life.
So where can listeners go to find more of your research writing? Is it just the blog, or there are some other places as well?
Right. It's on my blog, earlyretirementnow.com. And so on the blog, you can look for some of the other links. I'm on Twitter, so I actually respond sometimes on Twitter. I'm really lazy on Facebook. I'm not even mentioning my Facebook handle. Don't if you find me on Facebook and reach out, I mean, expect that I might answer after 3 months. But Twitter is probably the secondary secondary way of getting a hold of me.
Karsten, thank you so much for sharing your experiences and your insights with us today. It's been really incredibly valuable and insightful. And for those of you who want to learn more, I warmly encourage you to visit Karsten's blog at earlyretirementnow.com, where you can find a wealth of data, which I really like. A lot of tools, like we mentioned, the safe withdrawal rate tool, and thoughtful analysis on financial independence and retirement strategies. So it's a really great resource. And by the way, if you are looking also for the best ETF data and resources, I also can encourage you to visit etfatlas.com, where you can find ETFs from United States, Canada, and Europe. So thanks again for listening. Thank you, Karsten, and until next time.
Thank you.
Thank you.